basically, the Federal Reserve is a bank. I mean, it's called the Federal Reserve System, but there are 12 regional Federal Reserve banks. They may be, they're actually privately owned. They're owned by commercial banks. They're directed from Washington by political appointees. So it's this kind of hybrid public-private system. But that aside, there is a consolidated balance sheet just rolling up these 12 regional banks, as I described. It's publicly available. You can go to the Fed website and find it. It's not some deep, dark secret. But they keep their balance sheet, and they have an income statement also, but they keep their balance sheet on an historic cost basis, which means that if they buy a bond at par, and it yields, say 2%. Say they buy a 10-year note at par and it yields 2%. And interest rates go up to 2.5%. Well, bond math 101 is, interest rates go up, prices go down, or interest rates go down, prices go up. So in that example where interest rates go up, which they have, the value of that bond went down. Now, but the Fed doesn't mark to market the way a hedge fund, but kind of grew up in the hedge fund world, so I mark to market every day, sometimes intraday, but the central bank doesn't. So they're always going to have that bond at 100. So out here in secondary market trading, that bond's going to go down when interest rates go up. It'll go up a little when interest rates go down. But on the Fed books, it's always going to be 100 until it matures, and maturity could be 10 years from now. So what you're referring to, Nick, and there was an article in Reuters, and I read it, it was a good article, and someone said, well, interest rates have been going up. And the Fed balance sheet is huge. It's still, kind of in the neighborhood of $7 trillion. They're trying to get it down, but with quantitative tightening, reducing the money supply, but that'll take years. $7 trillion balance sheet, it doesn't take much of a rise in interest rates, and you mark those bonds down. And where does that come from in the accounting sense? Well, it comes out of capital. So could you get to the point where your mark-to-market losses are so great that you've wiped out your capital, at which point you would say you're insolvent? That's what insolvency means. It's different than illiquid. The Fed's not illiquid. They can always print money, but they could be insolvent. So, you have to do the math, but it's not that difficult. I've done it before. I haven't done it lately. But if someone said to me, well, on a mark-to-market basis, the Fed's insolvent, I would kind of shrug and say, yeah, maybe they are. The question is, does it matter? Do everyday Americans or everyday Australians, because this could be true of other central banks, the Reserve Bank of Australia and others, actually understand what we're saying? It's not that difficult. You can explain it to people, but people have lives. And, do they actually pay attention to it? Do they actually care? Probably not in most cases. It's a little bit of inside baseball. And then, as I said, what the central banker, no need to mention her name, but said to me was, well, first I said you're insolvent on a mark-to-market basis. That was my opening. It was my gambit. She said, no, we're not. And I said, well, I think you are. And she said, no one's done that math. I said, well, I've done it, and others have done it. And that's what we see. And then she harumphed a little bit and said, well, it doesn't matter. Central banks can't go broke. I mean, those were her exact words to me. So I was like, okay, well, that might be interesting to everyday Americans. That's what you think. So the point being, they think it doesn't matter. Most people probably don't care. But what the article you're referring to, what it was getting at was, okay, you're solvent on a historic cost basis. You might be insolvent on a mark-to-market basis, but you don't mark-to-market, so no one really knows. But what really matters is that you could have your cash flow could dry up, because what does the income statement look like? Well, the Fed makes money on these bonds. The Treasury pays them. You own the bond, you get paid by the Treasury. But what is the central bank paying? Well, they're not paying for cash. They print it, and I always say, a $10 bill is a permanent non-interest bearing security of an occasionally insolvent bank. That's kind of what money is. But money is on the liability side of the balance sheet. But they have excess reserves, which are deposits from members of the Federal Reserve, which are the big banks, JP Morgan, Citi, and Goldman Sachs and others. And they pay a little bit of interest on those. So you're making interest on your bonds, you're paying interest on your excess reserves. But do you get to a point where you've rolled over maturities, and you're making less and less money on those bonds, but interest rates are going up, so you're paying more on the excess reserves, and you could actually have either negative cash flow or reduced cash flow.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information, and it helps us spread that message. Sharing is caring. And now, let's continue.
Yeah, that's possible. And what does the Fed do with their profits? They give it to the Treasury. They give it back to the Treasury. So, and then that helps offset the budget deficit. So this whole thing is connected. So at the margin, it could have a slightly negative impact on the budget deficit. The Fed could have negative cash flow. I don't know that they're there yet, but that's, it's an interesting possibility. But just to take the Fed side of the debate, we talked about marking to market the bonds, which are probably, almost certainly, it's not a mystery, almost certainly worth less than what the Fed paid for them. By the way, everything we're talking about, you can apply in spades to the mortgage-backed securities. And that's a bigger problem. They're less liquid than treasuries, and mortgage rates have really been going up. So the value of those mortgage-backed securities that were originated at 2.5%, 2 7/8%, 3.25%, when mortgages are now 5.5% in the U.S. That's really where the big loss has come in. But the Fed has a hidden asset. If you go to the balance sheet, go to the asset side, the first line item, there's something called gold certificate. And what is that? Well, in 1934, the U.S. Treasury confiscated the Fed's gold. They had already taken the gold from U.S. citizens by that point, but they wanted it all. And so they took the Fed's gold, but under the but again, bearing in mind the Fed's privately owned. So under the Fifth Amendment of the U.S. Constitution, it is illegal, it's unconstitutional to seize property without paying just compensation. You can do it, but you got to pay the person. And then people get into all kinds of arguments about what it's actually worth. So what just compensation did the Treasury give to the Fed when they took the Fed's gold in 1934? The answer is they gave them a gold certificate. It can be, you can calculate it. In other words, you can say, well, what is the amount of gold by weight, not by dollar value, but by weight, that is needed to back up that certificate given the historic cost? So the answer is about 8,000 tons. Guess how much gold the Treasury has? About 8,000 tons. I mean, one of the reasons I've hypothesized that the Treasury stopped selling gold in 1980, because they lost gold to trading partners between 1950 and 1970. They lost 11,000 tons. They went from 20 to 9, but they sold another 1,000 tons in the 1970s to suppress the price of gold, which failed because it always does. But by 1980, they had were down to 8,000 tons, and they stopped. Why did the U.S. stop selling gold? We've never sold any significant amount of gold since. The answer is, in my view, is that they can't go below that, because that's the amount of gold the Treasury needs to back up this gold certificate on the Fed's books. So, okay, just kind of put that to one side. That asset is valued on the Fed's balance sheet at $42.22 an ounce. The price of gold, look today, it was about $1,850 an ounce. Now, so, what's, as I say, sauce for the goose is sauce for the gander. If we're going to mark the mortgages to market in a world where interest rates have gone up and the mortgages have gone down, it's only fair to mark the gold to market. And if you mark that gold to market at $1,850 an ounce versus $42, voila, you would find that the Fed has another approximately $350 billion of hidden assets. So I think that takes care of the solvency problem. So before we beat up the Fed on mark to market on mortgages, that's fine. But